Welcome to Kitco News. I'm Niels Christensen. The lockdown measures are starting to ease, but there's a lot of uncertainty. And investors and economists are trying to forecast their expectations for the global economy moving forward. Joining us today to talk about his expectations for the global economy and how investors can structure their portfolio post-COVID-19 pandemic is Richard Laterman, portfolio manager at ReSolve Asset Management. Thank you very much for joining us today, Richard.
Thanks for having me.
So before having you on, I listened to a podcast. You talking about the global economy and sort of four scenarios. What's your expectations for the economy as we start to look past the COVID-19 pandemic?
Yeah, so as you mentioned in the pandemic portfolio podcast that we did, we provided a slide deck, and you'll see, maybe you can pull that chart up, the growth and inflation dynamic chart. So this is a framework that we use to think about economic dynamics. And on the upper left, you would have the slowing growth with high inflation, akin to the 1970s. On the upper right, you would have growth and inflation similar to what we had in the 2000s. In the bottom right is the growth with low inflation that we had in the past decade. And then on the bottom left, the deflationary bust. So 1929, 2008, and most likely the current environment. So it does seem like we've just experienced a dual negative shock, and we're all in some form of quarantine, even though they're starting to discuss lifting them, but most likely a soft reopening of the economy. And we're likely in a very path-dependent moment right now, right? How does this pandemic evolve? Are we going to have a vaccine? Are we going to repurpose existing drugs, find new drugs to fight the disease? Are we going to have a second wave? And so this is all going to be predicated on that, as well as policy response. Because what COVID has done is exacerbated an underlying problem, which is very acute and has been brewing for decades, which is debt overhang, too much debt in the system. I would refer to the 2020 Decade Outlook piece that I wrote for you guys late last year, when I mentioned that this would be one of the central themes in the coming decade, how to deal with this debt overhang, which we know stifles growth, creates instability, and traps countries in a debt cycle, which has a handful of ways to be resolved. One of them is austerity. Another one might be default. We know that those are a little too painful, especially in the current political environment. And it seems like central banks have chosen their course, which is the expansion of monetary base. So that could have potential implications for inflation going forward.
What are your thoughts on monetary policy in reaction to the COVID pandemic?
Yeah, I mean, in previous recessions, the average rate cut is about 400 basis points, but it does seem like we don't have anywhere near that slack. And so there's talk of an exhaustion of monetary policy. There's also talk of negative interest rates, but what we've seen in that is that it just weakens banking systems, and it does very little, if anything, for growth. And with the US banking lobby as strong as it is, doesn't seem likely that it's going to happen. I mean, it could happen. The Fed has been flirting with inflation more and more. They've introduced a new framework where they're referring to the lower range of interest rates as a lower bound as opposed to the zero bound. So a little bit of nuance in the wording there, as well as talking about rolling inflation windows. So whether if we've experienced a recent period of sub 2% inflation, they'd be willing to accept higher inflation for the next period. So and this, I think, relates a lot to the shifting concerns of generations. I mean, policymakers in the 70s and 80s were concerned about inflation primarily. And then in the 1990s and 2000s, the conversation shifted to the moderation of the growth cycle. And after 2008, it really has been inequality front and center. And central banks have been calling for governments to step up. And so I think it's likely that fiscal policy will play a bigger role going forward. There's talk of a Green New Deal, for instance, which could be inflationary as well. And it seems like the Europeans are a little bit ahead on this when they appointed Christine Lagarde to the helm of the ECB. She's a skilled political negotiator, not really an economist. but I think they're understanding that the new leg of stimuli going forward will come from fiscal policy as well. And it's funny how a lot of these policies that were fringe ideas like modern monetary theory, universal basic income, helicopter money, they've gone from fringe to kind of mainstream. All politicians now seem to be talking about these things. They've entered the Overton window, and populism is both rampant on the left and on the right. It's a global phenomenon, and as crisis, necessity, change. So COVID has been a catalyst to a lot of these changes that we were probably going to see in the next decade, but may appear a lot sooner.
So what do you think? You put your feet to the fire then. I mean, what if you had to put a percentage on, sort of what environment do we see? I mean, is it stagflation? Is it low growth with low inflation? Is it significant growth with no inflation? What's your expectation? What are the chances that we see for the economy?
Right. I would just caveat that at ReSolve, we don't make any macroeconomic predictions, and we kind of build portfolios that can dynamically adjust to the environments. Right now, it does seem like the deflationary bust environment is where we find ourselves in. And the question really is how policy will respond and how we will then evolve in terms of how much money is going to be printed. I would say there's a fair chance that given the whatever it takes sort of environment that we find ourselves in terms of policy response, that we might see inflation creeping back after being dormant for so long. And there's also the potential for a little bit of deglobalization. There's talk of breaking in supply chain, so that can also cause inflation to resurface.
So then, how do you build a portfolio? What exactly, does that look like post COVID-19?
Yeah, so most investors have a combination of stocks and bonds. That's their core portfolio, and the so-called 60-40. But we know that can struggle for sometimes many years. And recency bias and anchoring and adjusting and all these things will typically make investors slow to react. And we believe a successful portfolio has to have the ability to invest in a global set of asset classes. And these asset classes can then thrive in different economic and market regimes. So this is kind of the adaptive asset allocation framework. We also use a number of well-established macro factors to help us dynamically respond to these growth and inflationary shocks. That's kind of the core thesis of what we do. And obviously, we have varying preferences for risk for different investors, and we have different levels of volatility for that investor. But the common thing really is mandate flexibility and portfolio agility. That's what I think must be a core holding for investors going forward.
One of the things that popped out to me in your research, especially looking at that graphic with the different economic scenarios, is gold does well in 3 out of the 4 scenarios. What role does gold play in a portfolio going forward?
Yeah, I mean, if we do indeed see inflation creeping into the economy once again, and in this sort of race to the bottom environment for fiat currencies, it's looking more likely that can happen. Gold and precious metals in general, as well as commodities, will have a place in portfolios, and they can be a very good source of return for investors. As you rightly mentioned, gold tends to thrive in 3 out of those 4 regimes for many reasons, because it's a recognized store of value for millennia. It's an effective hedge against both inflation and systemic risk. It's liquid, it's finite, all those things that I'm sure you and your viewers are very well aware. And I think Ray Dalio has a good quote on this. It's people who don't own gold or aren't even contemplating it for their portfolios either don't understand economics or don't know history.
So how is ReSolve Asset Management using gold in their portfolios?
So we access gold either via exchange traded funds or futures contracts. We
Mm-hmm.
invest in global asset classes through those two mediums. And gold has a dedicated position in our risk parity portfolio.
Mm-hmm. Mm-hmm.
And for our other strategies, we have the ability to invest in gold depending on some of these different signals that we get from these macroeconomic factors.
Just roundabout, are you underweight, overweight, neutral on gold?
In adaptive asset allocation, we invest in the asset classes that are producing best prospective returns.
Mm-hmm.
And gold hasn't really been an attractive asset classes for a long time. So,
Mm-hmm.
with regards to the recent past, there's definitely more gold than there has been, say, for the
Mm-hmm.
last 5 years.
Mm-hmm.
But if we were to see an environment where inflation is creeping back up and we're having very low growth, for instance, it's likely that the position in gold would rise.
Mm-hmm. Mm-hmm. Last question. I just wanted to I think this is a question sort of on everybody's mind, is how much gold should they have, and maybe not even just gold, real assets. I mean, we talk about the 60-40 portfolio. What's the percentage that people should hold in sort of real assets? And I know it's sort of everybody, one size doesn't fit all, but just generalities. Gold, for instance, everybody says, well, it's good to have 5 to 10% of your portfolio in gold. I'm sort of wondering, what are your thoughts on that?
Yeah, I think the 5 to 10% range for a dedicated position in gold is reasonable. People have
Hmm.
to remember that gold comes with a bit of volatility, so it's not a low volatility asset. So it works both ways in that regard. And when you're talking about real assets, you can be referring to real estate, for instance, as well,
Hmm.
which
Hmm.
for a lot of people is a big chunk of their portfolios. But real estate has a lot of nuance around it, depends on jurisdictions, tax implications, location, things like that. But given the uncertainty that we find ourselves in,
Hmm.
it's hard to imagine a dedicated percentage of a portfolio to specific asset classes. I do think that gold has a place, but
Hmm.
more broadly speaking, for real assets, I like the ability to transition in and out of asset classes as the environment shifts.
So liquidity is the name of the game then.
Yeah, I would say so. I think in the pandemic portfolio
Hmm.
podcast episode that you mentioned, this is one of the things that we refer to. I mean, having a higher level of cash in your portfolio right now is a reflection of the increased uncertainty. And
Hmm.
so,
Hmm.
and then having that cash to be deployed towards asset classes as the inflation and growth dynamics shift, I think that is a one of a few ways that portfolios can position themselves going forward.
Um, this has been a fantastic conversation, Richard. Thank you very much for your time. It's been a pleasure talking with you.
Yeah, likewise. Thanks for having me, Niels.
Thank you for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe and stay healthy.